Good afternoon, George Cavaligos for HFT Bonds. Sorry I did not get the video out yesterday. I was having some technical issues with this thing. I got to go buy a new webcam. The speaker wasn't working yesterday. Never could figure out why, because every time I tested it, it worked fine. Oh well. Market. A little bit of a dip last night. I hope you guys were looking at that 131.18.19 area, and I'm still kind of looking at that area for a dip. Looking forward here on the 10-year. Bonds, didn't make new highs this morning, and there's one thing, I'll try to emphasize with you guys over and over again. When we're in these consolidation phases, I think we're up here in some kind of a fourth wave consolidation phase. After the big rally early this week, the market, sort of settled into this little range up here. We saw something this morning that I call a divergence. Not me, I didn't make up that word, but the 10-years made slightly higher highs, and as they were doing so, the volume didn't explode. It diminished, actually. The bonds never even got back to their recent highs. What's the recent high in bonds? 144.25. 25.26 is a pretty key area in the new June bond contract. We'll have to watch that. 10 years previous high on the June contract was 131.27. Well, the 10-year went up to 131.29 this morning, and the bonds never at that point even got back up to 20. So I looked at that and I said, okay, we got a little divergence here. And as the 10-year was making those highs, we put up on a 30-minute chart a little bearish candle. The volume increased on that candle, so we put on a little short on that divergence. And we covered it down around 23. There was a low volume area on the previous run up overnight. I always like to cover on those low volume areas. The market has a tendency to go and back and fill areas that it kind of skipped over. So if you watch your price ladders and you see these low volume areas where it's just kind of glaring at you, the market will have a big tendency to go back and fill that low volume area in. And that was basically the one trade today. I think that was the only trade I made today. We broke down, covered. I think it went down to 21 and then bounced back up to 27, and now we're going back down. The bonds bounced back up to, what, 144.17 after making the highs at 20, 21. So we're in this big consolidation phase, and what we're looking for is a move back down now. I'm labeling the top of today's highs as a little B wave. C wave down again. C wave will either go a flat formation where it retests the previous lows at either 21 in the 10-year, or maybe even last night's lows at 18 plus 19. C equals A off of the move. If you look at a 30-minute chart, high at 29, down to 21, up to 27, down to 19. C equals A. It's pretty simple. Same thing on the bonds. 22 high, down to what, 144.03, back up to 144.18, down to 143.30. C equals A. You got to be on your toes when you're making new lows or testing previous lows. If you're testing previous lows and you do like a one tick lower low and the volume's decreasing, cover there and get long there. If the volume's increasing as you're taking out these previous lows, probably going to go to the C equals A target at the next level down. So C waves can be flats where you just bounce around within the same parameters, which is, if you look at the bigger picture on an hourly chart, that's all we've done over the last, what, 1, 2, 3, well, basically since the rally on Monday. So all week this week we've consolidated up at the highs here. If you look at the June 10-year, it's been between, what, 131.13 and 131.29. And if you look at the bonds, we've been between 143.15 roughly and 144.25, 26. So those are your ranges. Watch the market as it tests those range extremes. If it goes above these extremes with increasing volume, it tends to be a breakout. You want to go with that trade. If it goes up to those extremes, like this morning when the 10-year got up to the highs on decreasing volume, back into the range. Or like this morning, the 10-year was making the new highs and the bonds weren't confirming. They never gotten above, even back up to their previous highs. Divergence. Okay, lesson, kind of cool. Remember though, if this is a fourth wave, at some point, if we don't take out the lower end of this trading range convincingly, we're going up to make new highs. And with the rollover gaps above us and very little news, Monday there's nothing. Tuesday there wasn't very much. I think we got some M&I data again. Wednesday, I believe, is the ECB and the Bank of England meetings. There's a lot of talk that the Bank of England is going to increase their QE program, and that the ECB is going to cut their rates, which they got plenty of room to cut. You know, if they're up at 2.5 on short-term rates there. So, okay, have a great weekend. Try to buy dips back towards the lower end of the range. That's my favored trade here. Or if you see a breakout of the range on the upside with good volume, you want to go with that trade. That's a tough one, but you got to keep, you got to really watch how it gets above, the previous highs or the previous lows. So, all right, guys, that's it. Have a great weekend. See you Sunday night, Monday. Have a great one.